Hello. In this video, we're going to go over the declining balance method for calculating depreciation expense. So let's start with the screen share over here. Okay. We are using information that had been used previously for a different exercise. Lockhart Company purchased a machine on January 1st, 2017 for $80,000. The machine is estimated to have a salvage value of $8,000 and a useful life of 8 years. We are now going to use the double declining balance method. And in part B, we are using the double declining balance method with one change. And the change over here is the date of acquisition. Instead of Jan 1st, we're going to say it's acquired on October 1st, 2017. So let's start out with pulling out all the pertinent information and writing that out on the side over here. We start out with the acquisition date for the asset is Jan 1st, 2017 in part A. The other information that we have that's relevant is the original cost is $80,000, estimated salvage value is $8,000, and since we're using the declining balance method, whether it's double declining or declining balance in any of these methods, this salvage value should be ignored as we start the problem. It's taken into account only at the end. So my depreciation base is going to be the full $80,000. The estimated useful life is 8 years. So in this method, I calculate the rate of depreciation under the straight line method, which is 1 divided by life. In this case, it's 1 divided by 8. That gives me a rate of 12.5%. In this problem, I've been asked to use the double declining balance method. So I double the rate. That's where the word double comes from. I'm going to double the rate. So 12.5 times 2 is 25%. I'm going to set this up as a chart so that we can look through the exercise for all the years, all 8 years. So my column headings are as follows. The first column I have is for year. The second column is the book value, that declining book value. In the third column, I have the rate. I've already calculated the rate to be 25%. That's a number I'm going to put through over here. So I'm going to highlight that here. And the depreciation expense, I'll show you how it's calculated. So the ones that I can put all the way through is the years. I know what the life is. And the rate of depreciation, I already know that number. That's not going to change. Okay? So what's going to change is the book value, and then accordingly your depreciation expense will change. At the start of 2017, my book value is the original cost. So this number, I'm going to highlight it in a different color here. You can see this. It is the original cost. The book value when I start out is the original cost. So how do I calculate depreciation expense? Very simple. Depreciation expense is calculated as the book value, the beginning book value, multiplied by the rate. So 80,000 times 25% will give me the depreciation expense for the first year. So my depreciation expense in the first year is 20,000. Let's do the journal entry on December 31st, 2017. Fairly straightforward. December 31st, 2017, depreciation expense debit, accumulated depreciation credit, $20,000. What is the book value of the asset after this journal entry? Book value is original cost minus accumulated depreciation. So my new book value is down to $60,000. In the second year, my depreciation is calculated as 60,000 times 25%, which is going to be $15,000. So at the end of my second year, when I do my journal entry, the adjusting entry at the end of the year, it's going to be depreciation expense debit, accumulated depreciation credit for $15,000. What's the book value of the asset at the end of 2018? It's the 80,000 minus the accumulated depreciation, which is 20 plus 15. Or you can simply do 60,000 minus 15,000. My book value is now down to 45,000. 45,000, 25%. 11,250. Now, as I'm using Excel, I can copy and paste and just bring it down all the way through. And here what you're going to notice is I need to depreciate the asset down to its value at the end. So towards the end, in the last couple years, depending on what the management decides about the asset, whether to get rid of it sooner or keep it longer, they may continue depreciating it. In this exercise, I brought it down as close as possible to the depreciation base, the estimated depreciation base. Remember, the salvage value as an estimated number. A lot could change for any asset over 8-year life. So a lot of companies just choose to make the adjustment towards the end. So once again, when we are looking at the declining balance method, the rate of straight line is 1 divided by the life. Look to see what the problem says. If it's double declining, you'll multiply by 2. If it was 150% declining balance, you'd multiply by 1.5. Ignore the salvage value as you start the problem. Salvage value is taken into account only at the end. You want to depreciate the asset down to its salvage value. So in the last year, you will make an adjustment so that it calculates so that this number becomes 72,000. Okay, now let's look at Part B and see what's going to be different. In Part B, we were told that depreciation expense has to be calculated, again using double declining balance method, but assume that the asset was purchased on October 1st, 2017. So how many months did I have the asset in the first year? October, November, December, that's 3 months. I didn't have it for the full 12 months. So let's see what's going to be different. Again, in this exercise, I'm going to start out by identifying all the pertinent information. It's all the same as the previous one, so I'm just going to copy that down here, all that information. So I have the exact same information down over here. I'm going to create my table. Again, the years are the same. The rate is the same. The starting point is going to be the same number, that 80,000. That hasn't changed. Okay. So my first year, the depreciation expense, I'm using the same formula, is going to be adjusted for 3 months. Okay. So what's the difference? It's going to be 80,000 times 25% times 3/12 because I had it for 3 months, October, November, December. So instead of the full $20,000, let's look at the difference over here between the two. Instead of 20,000, my depreciation expense in Part B, I say, is only 5,000 in the first year. So what does that do to my future calculations? My future calculations are fairly simple. What's the book value? Let's do the journal entry to see what happens to the book value of the asset. Original cost minus accumulated depreciation of 5,000. The book value is 75,000. On 75,000, I calculate 25%, and I come up with 18,750. Then at 75,000 minus 18,750, that's going to give me the new carrying value of 56,250. So what you will notice over here is these numbers are going to be different because the first year's depreciation was different. And the reason it was different is I depreciated only for 3 months. Again, it's a fairly straightforward calculation if you're setting this up as a table. And again, you will see at the end of the life, I need to adjust the numbers so it comes down to $72,000, assuming that's the desired salvage value I want to come up with. So what would be different in journal entries over here? The difference is in the amount that I bring over here. It was 20,000 in the first year, 15,000 in year 2 in Part A. In Part B, it's 5,000 in the first year, 18,750 in the second year. Again, remember some of the basics. We are going to ignore the salvage value as we start our calculations in the double declining balance method. Calculate the rate of depreciation as 1 divided by the life, that's a straight line. Then see in your problem if you've been asked to, what type of declining balance you've been asked to use. In this case, it was double, so I multiplied by 2. I'll set up a table over here. First column, I have the years. Second column is book value. Third column is rate. I know the rate, what it is. I bring that down all the way through. Fourth column is depreciation expense. Book value, the beginning book value times the rate will give me depreciation expense for the year. The beginning book value minus depreciation expense gives me the new book value, and carry the formula all the way through. Usually you'll be asked to do the calculations just for the first couple years. So if you can just do it for the first couple rows, you're fine. You don't need to do the whole thing. But it's a good thing to do all the way through if the life is not too long. That way you can verify that your calculations are correct. So this is the double declining balance method. In the next video, we're going to look at yet another method of calculating the depreciation expense.